Hi everyone, welcome to today's webinar. My name is Fawad Razaqzada, market analyst with Think Markets. I am based in London and my colleague Victor is also joining us from Sofia. And this
Greetings.
webinar, hi, how are you doing, mate?
Very well.
Excellent. Love the optimism. Are you looking forward to the end of the year?
Any person who survives COVID is very optimistic suddenly.
Yeah,
as you might as well know.
Yeah. We both had the virus, and thankfully we're still alive. So we have to be optimistic.
So keep your chin up, guys.
Yeah. So let's begin this webinar then. For those of you who are here, this webinar is mostly technically based, but we do touch on fundamentals, and it happens every Tuesday. And what we do is we look at live charts and talk over the charts and take any questions that you have. So before we do begin the webinar, it's important that you're aware of the risks involved in trading. And so I'm going to read the first paragraph. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investments based on any information in this webinar. Please remember that the spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So yeah, I mentioned the agenda very briefly at the start. Next week, I will be away and Victor will be here. So that will be the last kind of weekly webinar that we do have for this year. And then our webinar series will resume in January. So this will be the second last, and then we have one more next week. So what's driving the markets? Well, lots of things really. It's from Brexit, vaccine hopes, and the still rising virus cases, which is kind of counteracting some of the optimism from vaccines. But over the if you zoom out a little bit and think over the last couple of months, it's all been about vaccines and how that will impact demand, and so price of crude oil, commodity dollars, and things like that have all risen as investors look forward to kind of more normal times ahead in 2021. However, as the OPEC warned yesterday, I think it was, demand for crude oil is going to rise less sharply than anticipated, and that weighed on prices initially before bouncing back. And also, we're seeing more lockdowns and restrictions across many parts of Europe and also in the US, which means in the short term, there's lots of uncertainty regarding the lockdowns and the impact of that on the economy and jobs. So we're still not out of the woods just yet. But there are reasons to be cheerful. Hopefully, 2021 is not going to be a repeat of this year, and it's going to be a fantastic year. I can't wait to see the back end of this year, to be honest. Also, kind of being a main focus point for the markets is Brexit. Talks have been continuing, and they got extended once again after another deadline was passed. And the current situation is that both sides, the EU and the UK, are still far apart on key fundamental issues, and time is running out. They have really not long to go. I think they have only got a couple of weeks now to hammer out a deal. But the fact that they both decided to continue talks rather than agree to disagree and go their separate ways without a deal, that has kind of raised optimism a little bit that a deal might still be on the cards. So for that reason, the pound has rebounded, and European stock markets likewise have bounced after suffering a bit of a sell-off. So yeah, that's what's happening. But let's see, in terms of data and central bank meetings. Also, this week is going to be an important one. I think it's the last important week for the year in terms of scheduled economic news. We have couple of really important economic pointers coming up. But more to the point is, I think, the central bank meetings. So we have the Federal Reserve on Wednesday. We have the Bank of England on Thursday, the Swiss National Bank on also on Thursday, and then the Bank of Japan on Friday. Now, Victor, out of these central banks, do you think any of them will provide further stimulus?
So from my side, I would say that hello, guys, do you hear me?
Yeah, I think you got cut off there. now you're back.
Okay. So from my side, I would say that the main flashpoints are actually centered on the Federal Reserve tomorrow, where we are expecting some sort of an announcement, and yeah, the likelihood is that we're going to see some form of yield curve control,
right?
Which is something that the Bank of Japan has already been doing over the past several years, really, like probably, if I'm not mistaken, since 2013.
It's been a long time. Yeah, they have been. I think yes, it's at least 4 or 5 years from what I can remember, but could be wrong. Could be longer than that.
Yeah. So the expectations into this meeting, as we can see from the market sentiment, which is continuing to be dollar negative despite a brief pause, like we discussed last week, just into the ECB meeting. We're seeing the dollar getting hammered lower and lower, and it's currently testing another key level, as Fawad is just showing us on the chart of the DXY, the US dollar index. So the Fed is expected to do something, and I think it's already priced in. So yes, so tomorrow, if you see the Fed adopting yield curve control, you might see a brief spike lower to take out some stops, probably as low as 90 on the DXY and above 122 on the euro dollar, just to take out some short-term traders, and some profit taking could result after that. At least that is the scenario that I have in my mind. But as previously discussed, this is not an investment advice. So stay cautious and basically observe what is going on with the Fed's announcement, and that's my primary vision of any big news that might come due this week. As to the Bank of England and the
Swiss National Bank,
the Bank of Japan, the SNB. I don't expect much from them. The SNB is probably going to stress once again that the Swiss franc is too expensive.
Well, it is, isn't it? Look at this. Swiss franc is gaining further strength against the US dollar. It's reached levels not seen since 2015, when since early 2015, I should say. That's when the Swiss National Bank last intervened in the market, and what an intervention that was. So obviously then they removed the peg, the Euro Swiss peg. They could no longer support the floor that they had set at 120 on the Euro Swiss, which is this currency pair here, and that caused the franc to rally rapidly. I have never seen such a move in one single day in my entire life, and that was something that took so many people by surprise. So the Swiss National Bank is it might be the most boring central bank out there, but when they do intervene, they go in big, And so the franc has been getting stronger, not so much against the euro, but against the dollar, and that's something that it might do something about. In recent years, it's continued to say the same thing, that they are ready to intervene in the FX markets if the franc gets stronger. Well, it has got stronger against the dollar. So are you going to do anything about it? That's the question that the markets are asking the Swiss National Bank. And I guess we'll find out on Thursday. So in terms of the Bank of England, I was half expecting the Bank of England to do something at this particular meeting, depending on the outcome of the Brexit talks. Now, on Sunday, the Brexit talks got extended. Had it not got extended, and we had and the two sides had agreed to a no deal outcome, the Bank of England would have surely intervened and expanded QE at this particular meeting that's happening on Thursday. However, as the talks are ongoing, I think the Bank of England will sit on its hands and wait the outcome of the negotiations before deciding on monetary policy. So it's just a case of wait and see from them to see what the politicians will come up with. If it's a hard exit or a no deal exit, then the pound is going to tank. That's what everyone expects, right? Because borrowing costs will rise as a result of the tariffs. That's going to choke economic growth. And so the Bank of England will have to do something about that by expanding their QE purchase and possibly lowering interest rates as well.
Are you personally optimistic about a deal?
I am. I tell you why. Because the negotiations have gone down to the wire, obviously, and we've repeatedly seen the deadlines, the self-imposed deadlines being extended. And we saw a repeat of that on Sunday. The fact that both sides are still kind of trying to hammer out the deal, that shows that ultimately I think one of them will blink, and I think it's going to be the UK. They will have to drop their demands a little bit.
Their demands for sovereignty.
Well, we have to respect that they can't have a cake. We can't have a cake and eat
it too.
Yeah.
Because the EU has to eat it.
Yeah, right. If you want kind of no tariffs, then you need to abide by other EU rules as well, or get out completely. So it's like, what the UK are demanding is kind of not it can't work from as far as
it's not realistic.
Realistic, exactly. So they will have to kind of water down their expectations a little bit.
Okay. Well, I'm not very optimistic on them watering down their expectations, judging from their behavior up until now. But I might be wrong. In any case, I wanted to let's take a look at the chart, and we had this we have this channel which is formed, an uptrend channel, which so far has been holding. And what is your view here? Do you see
well, I think
particularly new developments since last week?
Not really. I mean, nothing has changed since last week. We're still inside this channel, as you mentioned. I think it's going to be a binary outcome. So if there's a deal, we're going to spike through 135 handle. That's the key level now, because this level has been tested so many times, and so far price is holding below it. So it's a massive level of resistance for the market. And, recent tests of this level has led to progressively shallower retracements, meaning that the pressure is building for a possible upside breakout. And that can only happen, in my view, if we get a deal. So if we don't get a deal, I think it's going to tank and drop really sharply, because since March, I think people have been pricing in the prospects of a deal. And so if those hopes are dashed and we don't get a deal, then people are going to unwind their long bets on the pound, and that's going to cause a massive slide. So I wouldn't pay too much attention to the technical analysis on the cable, but it's important to still be, tactically prepared for any eventuality that might happen. So for that reason, it's important to have a structure. And one of the ways to have that structure is to have these key levels on your chart, like 135, 130, or this level here, because that's the low that was created prior to the latest
last week.
So yeah, so if we break that, then I think that's going to be bearish, because it could signal to the market, to technical traders at least, that price tried to bounce off the lows from the support trend of this channel. It's kind of failed, so it no longer makes sense to be looking for bullish positions. It could be that the market is aware of something that I am not. So for that reason, people are going to start potentially selling this thing if this level breaks at 131, 35. So that's the line in the sand for me in the short term. On the upside, 135 is the line in the sand. Break that, I think, on a daily closing basis, that could pave the way for a much larger rally. So if you can, zoom into a longer term chart, like zoom out rather, and look at the monthly here. This is a trend line that Victor made me aware of a few weeks ago. It's connecting the highs from 2007 with 2014. We touched that level in September of this year, and we're testing it again. So if we break this long-term resistance level, trend line, then that will be really significant, right? So going to the weekly chart now, you can see that it's kind of displaying the same information as we saw on the daily just now. Basically, it's consolidating ahead of that trend line and resistance at 135. But this blue box here shows that price has been making higher highs and higher lows because investors had been pricing in a Brexit deal over the last few months. So as I mentioned, if that deal does not materialize, then we could drop to possibly 120, because 120 is the low that was hit past in the immediate aftermath of the 2016 referendum. Yes, we went below it, but on a closing basis, on a weekly or monthly closing basis, that level is important. So in a no deal situation, I think 120 could be revisited in no time at all. That will come as a shock to the market. Do you have any? Go on.
Let's talk a little bit what happens if we do get a no deal.
Yeah.
And what happens in January? Do you have a view that the UK could undertake dramatically different fiscal measures, being free to do so, and actually that could result in a rebound in the pound after the fact?
Yeah, I think we're only talking about the initial reaction. So initially, I think the markets are going to panic, like it's the end of the world, right? That's always the case with these kind of things. And then afterwards, obviously, when the government has to do something about it, and they will do something about it, make no mistake about it, then that will hopefully support the pound again. We could see a rebound, but the rebound is not going to be a very speedy one, I don't think. Because any policy that the government makes, it's going to take time for it to filter through the real economy, and the markets are always kind of forward looking, and to some degree they will start pricing in the positive impact of what might happen in the future, but it will be more concerned in terms of the immediate risks, because a no deal outcome is going to hurt sentiment badly from both consumers and businesses alike. And in the short term, that could severely impact the economy, the UK economy. And for that reason, the pound is going to stay low for a while until the UK government gets this act together and starts to rebuild the economy. So yeah, initially I think it's going to be a sharp sell-off in the event of a no deal outcome, and then possibly in the months ahead it's going to start recovering again.
Okay, great.
Yeah, let's talk about the euro dollar very briefly, because it is continuing to follow the path of 2017. This is the weekly chart of I know it says monthly here. That's the weekly chart. In 2017, rates rallied, consolidated here, and then spiked further higher. And we're seeing a very similar pattern unfold: rally, consolidation, and now it's breaking out from its consolidation zone, and it's approaching a potential resistance area around 122, because if you zoom in a little bit, you can see that 122 was the base of the consolidation back in 2017 or early parts of 2018, before that big breakdown. So price is rising towards the former support area of that consolidation range, and we could see some hesitation there. But ultimately, I think the euro dollar is heading towards 125 and possibly higher, if past price action is anything to go by. And also because of optimism surrounding the vaccines and return to normal activity, that should help to support the euro being a more risk sensitive currency than the US dollar. So for that reason, I think it's most likely to continue heading higher from here, towards and possibly beyond 125 handle in the coming weeks.
And the stock market to 40,000?
Oh yeah, the stock markets will never go down, right? Yeah, no, that's a joke, by the way. Before anyone, obviously a lot will.
We both joked on that one.
Yeah, a lot depends on the stock markets, obviously. When the stock markets fall, this tends to support the dollar being a safe haven currency. And so, yeah, you always have to be careful and watch the stock markets closely if you're just a fixed trader. You know, even if you don't trade the stock markets, just watch the indices to see if you get any big reversals there. And then that could, if that happens, that could impact the currency markets. Now, let's focus on the dollar yen, because it's been such a frustrating currency pair to trade. Now, the dollar has been falling across the board, right? Except against the yen. Now, the reason for that is, the Japanese yen is a haven currency. And so it has kind of risen against other currencies. Like if you look at the pound, it's fallen against the other currencies, like the pound against the euro, it's fallen. Against the Canadian dollar, it's fallen. Similarly, against the Aussie and the New Zealand dollar. You can see that the yen has been falling because of the ongoing risk rally. Now, for that reason, the dollar has been able to hold its own relatively better against the Japanese yen than against any other currencies. But I think a big breakdown is coming up soon. And who knows, this FOMC meeting and the Bank of Japan meeting could be the trigger behind the potential sell-off. So this is the kind of, on the weekly time frame, we have this bearish trend line rather, capping the gains. Short-term moving trend line connecting these recent lows has broken down. Yes, we've bounced back really sharply, but let me go back to the daily chart to show you a couple of interesting points. Here I've circled a big red, green candle, or white in this case, showing strong bullish momentum. Yet after that candle was formed, ideally what should have happened is for price to stay there for a few days and then continue higher. What happened in reality is price went down, thus trapping the bulls that bought into that rally. We saw another big rally here. Yet again, there was no upside follow through, and price fell. Eventually, we went below the lows of that candle at around 103.70. So yesterday's candle, when it rallied off the lows, creating this doji-like candle, that might look bullish on its own, But given the overall bearish price structure and given what's happened on the left-hand side of the screen, where I highlighted a couple of big bullish candles that showed no follow-through, I'm expecting a similar outcome for this candle. So what I thought might happen after this candle was formed yesterday is that price will take out the high of that candle, which it has, and it is going to go down from there, which so far it's doing that. The candle, as you can see, is red. So I think from here, it's going to fall, if I'm reading this correctly. Take out the low that was created yesterday, where there's lots of stop orders resting from people who bought into this. And then the big stops are going to be resting below this low here, the November low. And so I think—
So 1 and 3 will be key.
Key in the sense that it is going to, I think is going to pull—
Let's say the area between 103 and 103.20 is where these stops are. And
yeah, so
once
I think
those give up, it's,
yeah. So what I'm saying is that the implication of this is that when the thing breaks down, this breaks down, if it does, it's going to do so in a very accelerated way, because a cluster of stops are going to be tripped, and that's going to cause price to go down really sharply, if I'm reading this correctly. So that's why I keep mentioning what's happened here. And the fact that price has spent so much time in this consolidation zone, that also implies that the eventual breakout is going to be, or breakdown is going to be significant. So that's why I think it's going to move really sharply, but move sharply if it breaks to the downside, in my view, rather than to the upside. Obviously, I could be reading this completely wrong. The dollar yen could rise. If it does, we'll need to see a clean break above this bearish trend line. And I want to see some further bullish price action before I turn bullish on this market. But as things stand, I think the path of least resistance is to the downside. And obviously, given the overall dollar structure against other currencies. So I think the dollar yen is going to follow suit. Do you agree to that view to some degree, or
so basically, to me, the key the next key directional move in the dollar, is going to be determined by the elections in Georgia.
Okay.
Which are on the 5th of January.
Okay.
And assuming the Republicans win at least one of those two seats,
yeah,
I see a rally in the dollar, because we're going to have a hung parliament of sorts.
Okay.
With Republicans retaining control of the Senate, and thereby blocking any dramatic fiscal expansion measures which the Democrats are willing to push through. And this I think could turn into some dollar strength.
Okay. So obviously by Georgia, you're talking about the U.S. state, not the country, just to put it out there.
Yes, correct.
Okay.
Just in case.
Just in case. Because when you mentioned elections, I was like, okay, the U.S. elections have gone. Georgia, they're not very important in the grand scheme of things in the markets. No disrespect to any people from Georgia, but in terms of the financial markets, they're not a big player per se. But anyway, obviously Victor is talking about the state.
The U.S. state,
of Georgia
holds the key to the Senate right now. We have 2 seats for the Senate, which are being rerun after the elections on November 4th. And we're going to have a very brutal fight for these seats. So let's see what happens.
Okay, excellent.
That said, if the Democrats win both seats, we certainly might see more weakness for the dollar.
Yeah, that's also possible. Absolutely. And if we do see weakness for the dollar, then maybe it might be a good time to look at gold again, because It's holding its own relatively well after its recent down move to the 200-day moving average, where once again it found support like it did previously, and so far it's holding above that 200-day moving average, and it's showing some bullish characteristics as well as it tests this potential resistance area between 1848 to 1865, which was formerly support. So it needs to now break through this area, in my view, and if it does manage that, then we could see a nice break to the upside. I want to show you the intraday charts as well, because something interesting is happening on that time frame.
Yeah, we had a nice bear trap yesterday. With prices dropping just below 1820 and
you saw
triggering
that,
some
yeah.
stops.
Yeah.
I actually, perhaps for the first time in a while, I'm actually bullish on gold here.
Yeah. So technically, what Victor just mentioned is this level here, or around that level. As you can see, it was kind of the neckline of this head and shoulders formation, right? So people seeing this head and shoulders, when price comes back to test it one more time, then the next time it came down here, it looked really heavy, and it should have broken down and stayed down. What happened instead is it broke down, but instead went back up rather than down, and it held above that break. And now what happened is we've taken out the most recent high prior to the drop. I think ideally I want to see this high taken.
Yes.
Because that was the last
1850, high. It stops above 1850.
Yeah.
Would trigger a move higher. If prices drop towards the 1825 area, this looks like a good level to buy.
Do you reckon
a tight stop loss below?
You see, I would disagree. If it comes back all the way down to 1825 again, I think I would be it would indicate to me that it's going to break down this time, because it shouldn't come back down there. If this was a bear trap, if this was a bear trap, the fact that we've taken out some interim resistance levels, to me, that it should continue going higher from here, like maybe a small consolidation where it is at the moment, then break higher. That's the ideal scenario. But if it comes all the way back to 1825, I don't know. I would think that, what the hell is price doing at this level again? If this was a strong bounce.
Well, we have had many moments of what the hell is the price doing here again this year.
Yeah. That's quite right as well. But yeah, there you go. It's healthy anyway to have different views on occasions. Yeah, and that's what trading is all about. People trading prices, right? Silver is looking really interesting, as you'd imagine. Well, not really interesting, but it's coming
kind
up.
Of interesting.
Kind of interesting, yeah. This trend line.
This major trend line is still capping prices for now, and last week we tested it. If we test it again this week and break through, that could be a big move.
That could be a big move. Notice how prices hanging around the 21-day exponential moving average. This red line here, 21-day exponential is a short-term moving average. When price is above it, it indicates that in the short term the bulls are in control. Longer term, the 200-day moving average is still pointing higher, and price is above it. So the longer term outlook is still technically bullish on both time frames. And if you zoom out a little bit to the weekly chart, and obviously same picture as the daily. Here we can see that silver created nice bull candle here a couple of weeks ago. Last week there wasn't much follow through, but equally it didn't collapse. So the fact that it's hanging in here tells me that people are willing to bid this market higher even. And also if you plot your fibs from the low to the most recent high, and you can see that price has bounced or held above the shallow 38.2% Fibonacci retracement rather than staging a deep retracement. So when a market rallies really aggressively, what you want to see next is a pullback to a shallow retracement rather than a deep retracement, because a shallow pullback would suggest that the selling that has occurred from here is mostly driven by people taking profit on their long positions accumulated here, rather than people actively looking to short sale this market. So this is why observing what price does around these Fibonacci ratios is important, and the fact that it's holding the 38 is significant in my view. So it needs to break through that trend line, obviously, and until it does that, I would be cautious on silver, but cautiously optimistic on a potential breakout.
So you mentioned some interesting news yesterday about oil. Would you like to talk about that chart?
Yeah, sure. So crude oil has been going up in the last several weeks, as you can see, and it's all to do with, well, it's mainly to do with optimism that demand for oil is going to recover in the year ahead because of expectations that travel will resume to more normal levels because of the rollout of the vaccines. People are going to become more confident about traveling again, etc., etc. And price of oil has been going up. Also boosting price of oil was the OPEC, which extended its production output cuts beyond January a couple of weeks ago. That helped to keep prices supported. However, yesterday, or I think it was the day before yesterday, the OPEC released its monthly oil report. Every month the OPEC publishes, a report to highlight what's driving oil prices. What's the current level of demand, supply, and what they think is going to happen in the future. They reported that the demand growth in the first part of 2021 is not going to be as strong as they had envisaged in their previous report. That caused oil prices to come sharply off the highs. You can see that on an intraday chart.
Yeah, we had quite the move yesterday.
Yeah, so it moved from just underneath 51. It was at 50.75, dropped all the way to 49.15, which is a big move, right? It's probably a 2% move, I'd say, probably a bit more than that. And so yeah, this is the move. Yeah, 3% move. That was a big drop. But what's interesting is how price has recovered and is still pushing higher. So now it needs to get past the supply zone from which it dropped, which is here. And if it gets above this shaded region, then that would clear the way for a possible move towards 52, possibly higher even in the days ahead. So the thing is, while the outlook on oil is looking increasingly bullish, and it's already made its move up, so I am not so sure how much further it's got to the upside, because yes, demand is going to recover, but also supply of oil is going to increase as prices rise. Shale supply is going to increase for sure. Also, the OPEC Plus will be relaxing their output cuts slowly, and that's going to weigh on prices. So I think where Brent is trading around at the moment is a fair value in my view. I think yes, it could overshoot 50 to the upside. We could get to 52, possibly even higher than that. But over the medium term, I think it's going to return back towards 50 until something changes significantly from a macro point of view. Do you have any views on that? Any different views?
Yeah, actually, I wouldn't say my views are different. I just wanted to reemphasize that the move in oil has already happened, and the lockdowns are in place. We're very likely to see 3 months of dead economic activity in terms of traveling in Europe and in the US, which is a significant risk to oil prices, in my view. Despite like the market has been ignoring these for too long.
Absolutely, yeah. And in the commodities market,
the moment that the market comes back to its senses, or the moment where enough people start realizing that there is no escape from this reality and start taking profits, we could see a pretty decent move to the downside.
Yeah, I agree to that, because unlike the equity markets, in commodities, especially oil, it's very fundamentally driven by supply and demand forces. So expectations can impact oil prices, but it's a more short-term driven market than longer-term dynamics. So, with the case of stock markets, people are being extremely bullish about the outlook, and they can hold that stock knowing that if it falls, it's probably going to come back because central banks are there to support it. Yes, you have the OPEC and other players like Russia who are actively intervening in the oil market that could limit the downside. But once oil is above ground, storage costs and stuff like that play a big part for oil. And when there's too much supply of the stuff, price has to go down for them to be able to sell what they have extracted from the ground. So I agree with Victor. I think demand for oil is not going to be as strong as people are expecting it at the moment in the next couple of months. So there's a greater risk that we may see a downward move than a significant continuation to the upside from here. But as technical analysts and traders, obviously, if you're feeling bearish on oil from a macro point of view, you need to see that reversal stick first on the daily chart or on any other time frames that you trade before trading on the short side.
So let's ask our attendees if they have any questions. We see.
Yes, if you have any questions, please ask in the chat window or in the other window. We'll get to you as soon as we can.
In the meantime, have you had any other assets to discuss, or have you thought about it?
Not really. I think it's just been a one-directional move for currencies. The dollar, we mentioned, it's been going down, so everything priced in the dollar has been going up except the Japanese yen, and the Japanese yen is starting to move lower, in my view. Starting to move higher against the dollar. So the dollar yen is going to possibly one more market that I wanted to revisit was the Turkish lira, which is right here.
Oh, that's an interesting one.
Yeah. So
we just had another round of sanctions against Turkey.
Really, I missed that one. From who was it? From the US, was it?
From the EU.
Oh, from the EU. Okay. Anyway, the reason I wanted to look at this particular market is obviously not everyone's cup of tea.
Sorry, that is from the US.
But it's from the US. Okay. Yeah. Obviously, the sentiment has been improving towards all risk assets, including emerging market currencies in recent times. But in early November, the Turkish central bank raised interest rates really sharply, like 5% or something. And they have introduced other measures to support the lira after falling to record lows against the US dollar. And all of that helped to push down this currency pair from its all-time highs, breaking through this bullish trend line. And then Price then rebounded to retest the broken support, and it's holding below that level. So for as long as it remains below this red level here at 8.03, the path of least resistance is to the downside. So I think if we can see further bearish price action, this could be a market to consider possibly looking for short trades after it had a very strong bullish trend for multiple years, as you can see. So this could have topped out, and therefore there is a possibility that we could see further falls in the weeks and months ahead as things turn towards more normal levels. But I think we need to see further price action, and a breakdown below this blue level here is key now, because that level was support, turned into resistance. We broke back above it, turned into support again. So we need to see that level give way to indicate to us that the sellers are more in control of price action once again. I don't have anything else to add, Victor. Do you? I can't see any questions.
No questions from our audience.
Okay.
So I think it's time to wrap it up.
Excellent. All right. So we will be back. Well, Victor will be back next Tuesday at the same time, 11:30 London time. And I hope you guys have a wonderful week ahead. It's going to be the last important week from a macro point of view before things calm down ahead of the holidays. So take care, and I'll speak to you guys soon.